without further ado, the president and founder of alphatrades.net, Brian Shannon.
Hi, everybody. Thank you. Can you hear me okay? Microphone good? Yes? Okay, good. Well, thanks for having me here, Dan, and everyone from Trade Ideas. If you're not familiar with their software, I would definitely tell you to check it out. And the right arrow is supposed to move me. There we go. So man versus machine. That's been a debate for a while. I think, though, that Paul Tudor Jones, the famous hedge fund manager who runs billions of dollars, said it best here: no man is better than a machine, and no machine is better than a man. I think I said it wrong. I had to read it. I thought I remembered it. No man is better than a machine, and no machine is better than a man with a machine. So integrating human knowledge along with the artificial intelligence and all the great tools that they have at Trade Ideas. So a little bit about myself real quick. alphatrends.net is my site. You can follow me on Twitter at alphatrends. You can buy my book on amazon.com, and I'm not going to turn this into a big, long commercial for what I do. Instead, I want to give you some good information, and here's what we're going to cover in the next hour. One, who is Holly? You hear the search for the Holy Grail. We're going to talk real briefly about market structure. A couple weeks ago, I did a webinar for Trade Ideas where we spoke about market structure. That was a little bit more in depth. So it's just going to be a quick review. And then we're going to talk about short sales. Why? Obviously to make money, but how do we do it? When do we sell short? And then more specific to today's market, short squeeze opportunities, why they occur, what is the short interest, where do you find that information, days to cover, also known as short interest ratio. And then we're going to talk about the short interest information that we get. And I think you're going to find it interesting, a little bit eye-opening, that it might not be as accurate as we actually think. And we're going to talk about what I consider two different types of a short squeeze. You hear the term generically, oh, the shorts got squeezed in that stock. One is a shorter term type of market dynamic known as what I call at least a knee-jerk short squeeze versus something more structural. So there seems to be a delay with the turning of these slides. I'm not sure where I'm supposed to point it to get it to go. Okay, so this is Holly, the little robot woman that you see. Pretty good looking for a robot. She watches the market for us and gives us a statistical edge. And it makes it super easy to look at any kind of strategy that you want to test. And you back test, look for the statistical edges. You can actually automate the entire trading process. My understanding is they call it in beta, but it is available. The next speaker is going to talk, I think, about how he does that. But the goal, of course, with any trading, it's a tool to allow you to become a better trader. Man versus machine. Holly is the machine. The man can get the emotions in the way. If you look at these market cycle posters, they're nothing new. But you don't want to get stuck in the emotional cycle that so many times we find ourselves getting involved in when we make rash decisions. Instead, we want to look at the market structurally. So the people here have a poster of this, and at home, if you look at my Twitter, it's the pinned tweet. You can see that there. But basically, I'm not going to read this whole thing to you. What I want to do instead is just point out two areas. One is, one is the stage 2 uptrend. That's stocks that we want to be buying. Stage 4 decline. Those are stocks you want to short. We heard guests earlier talking about, well, the Foot Locker, we're seeing good foot traffic in the mall and that sort of thing. But the stock is in a horrible downtrend. That is not a stock you want to buy. Wait for the institutions to take control and look for the actual evidence that the buyers are gaining control. And it's all time frame relative. I'm going to be talking mainly from a swing trading perspective. Keep in mind, there's all kinds of different ways to approach the market. This is the way that I like to look at the market, but as they say, it is fractal. So what applies on one time frame will apply to another as well. The way we want to look at it, though, is stage 1 and stage 3. I did that again. Stage 1 and stage 3. I generally avoid. It means a sideways choppy market. It doesn't mean there's not opportunities to make money in there, but for me personally, I prefer a trending market. I prefer a stage 2 uptrend. I want to participate on the long side, and I want to avoid the short side. It doesn't mean you can't make money on a stock that's going up short, on the short side, but what are the odds? The bigger odds, the sum of the rallies are greater than the sum of declines in an uptrend, higher highs and higher lows. So you have a mathematical advantage, and we need every single advantage we can get to make money consistently in the market. Stage 4 is where we want to short a stock. That's when we want to be short. Obviously, this market has been in a phenomenal uptrend for years, and there have been very little opportunity for the short side, from a swing trade perspective, for stocks that actually follow through. So we're going to talk about the risks, and I'm going to give you some, what I think are actionable ideas, hopefully, that can help you make money tomorrow when the market opens. Short sales, just real quick, it's the opposite of selling. We look to make money when a stock declines. So we borrow from the broker the shares to sell short that we don't own. And as the stock declines, then we buy them back. I will tell you that shorting, even in a bear market, is more difficult than going long in a bull market. It is very difficult. We have these real emotional short-term rallies in there. So the first foremost thing, risk management is always job number 1, but even more particularly in a stock that you're short, because things can compound very quickly. And stocks, the appeal is they come down real quickly. As they say, they take the elevator shaft down and the stairs up. So we want to stay with stocks that are in a stage 4 decline. They're guilty till proven innocent. It's a bonus if they have bad fundamentals, but the old saying is that the market climbs a wall of worry, like we're seeing now. We have North Korea, we have a president that a lot of people don't agree with policies, we have storms, we have all these things, yet the market continues to go up and people scratch their head and say it just doesn't make sense. It's not supposed to make sense. It's supposed to make dollars. That's why we're in the market. Not to analyze and theorize about, but we're there to make money. That's our job as traders. So if there's bad news, be aware that if it's, meaning you don't necessarily want to short on the bad news, it's often too late. News and surprises tend to follow the direction of the trend. So, we want to be aware of and I think this was mentioned this morning, takeovers. You see all kinds of rumors in stocks that are in downtrends. A lot of times they're just sucker rallies, knee-jerk short squeezes. But if the stock is in a downtrend, it's guilty till proven innocent. One of the things that I see people doing a lot is chasing in both directions. That is, the stock will be down 3-4 days in a row, then some bad news will come out. They'll talk about it, get a lot of press. Who's left to sell at that point? You have to learn, the market's a discounting mechanism. It discounts the past and anticipates the future. So there's people betting already against that stock based on the scattergram of how many sneakers are being sold in Foot Locker. This intelligence is out there. People have this information. If you're waiting for the news to base your trades, oftentimes you're going to be very late. A lot of times the stocks that are the obvious targets for short sales are, they're up too much. They've gone too high. Be really careful with those. A lot of times you'll see a fad type stock and you know deep down that the fundamentals are terrible on this company. But if it's an uptrend, don't short it because you can lose a lot of money. There is always something to worry about in the market. Our job is to manage risk and not get trapped in the emotional decision-making process. And you see it all the time on an uptrend, that these are the emotions. Well, think about, there's always short sellers in the market. In a much bigger capacity than I think most people actually realize on a day-to-day basis how much short activity is in the market. But these emotions occur upside down for the person who's short. So look at a chart and don't just try to say, okay, it's a stage 2. Say, who would be buying now? Why would they be buying here? What would the short seller be feeling? How would I feel if I was long, if I was short, if I was in cash? Don't chase. Don't let your emotions get in the way. So when I look at a short sale, what I want to do is, and we alluded to this on the last panel, is I think you want to look at a minimum of 3 time frames. People say, well, what time frame do you look off of? And for a swing trade, again, swing trade specific here is what I'm talking about, is that you want to first look at the primary trend, and I'd say on a daily chart. And the next question is, well, how far back do I go? As far as you need to go to see what's relevant. So if you have a stock that's at a 52-week high and you're looking at 1 year, maybe you have to go back a little further to the left, a little further in time, go back 2 years, maybe even look at a weekly chart to say what relevant source of supply and demand might come into this market that I can't see on the daily. Generally speaking, though, a daily chart, look for about a year. If the stock is in a stage 4 decline, it's below declining moving averages, it's making lower highs and lower lows. There's a lot of bounces in there, and people get sucked into those. But if it's below those declining moving averages, it's more likely to fail than it is to follow through, no matter how good the story might sound. How many times have we heard that BlackBerry is going to get bought out in the last 5 years? And every single time people fall for it, and the stock runs 10%, and everybody say, wow, it must be true. It's up 10% in the last 2 days. And then it trickles back down, continues to lower highs and lower lows. Now, it's starting to turn a little bit right now, so I don't mean to pick on BlackBerry. I'm aware of where it is, and it's just had a nice run this past week. But basically, a stage 4 stock is what we want to start with. That's our target stock. Now we have to say, okay, well, does it make sense to actually put my money at risk in here? I want to come up with my risk reward. And I look at it on an intermediate term time frame. And you can see here, what is the intermediate term time frame? It could be the 65-minute, the 30, the 10-minute chart. Generally, I'll go back 15 to 30, 40 days to see what information is there that I need to know. So if on that intermediate term time frame, we've got the stock in a downtrend, it's bounced a little bit, it turns sideways on the intermediate term time frame. So it's just under distribution. It's just rallied back up, and it's starting to turn sideways. That tells me that now I have the opportunity to stalk this stock. I want to anticipate how I'm going to trade this on the short side. It looks like the bounce is over. Now it's turning sideways. And as it enters that stage 4 decline on the intermediate term time frame, that's why I participate. So I want to anticipate the trade as it's in that stage 3, participate, and then as it drops down and starts turning sideways after a 3-4 day decline, it starts turning sideways, that's when I want to exit the stock. If it starts to bounce on the intermediate term time frame, yes, you can make money on the long side there, but again, when news and surprises follow the direction of the trend and the sum of the declines is greater than the sum of the rallies, well then I just want to avoid those. It's not on my radar for now. Then we'll look at a shorter term time frame. Could be a 10-minute, 5-minute chart. Generally if I have a 10-minute chart, I'll go back 10 days, 5 minutes, 5 days, just to kind of keep the scaling the same. But that's where you'll fine-tune your trade and say, here's where it's time to actually get involved. So here's an example of a stock that on a daily time frame, we can see I've got a 10, 20, and 50-day moving average here. The direction of the 50-day moving average, when that's declining, we want to look at it and say it's guilty till proven innocent. Doesn't mean it's just going to keep going down, but we give this benefit of the doubt to the sellers because they have control. So what we want to look at is, other technical things, such as what was down on big volume. Volume was expanding on the way down. Volume expands in the direction of the primary trend. And as we get a bounce, we see lighter volume. That tells us, what does that tell us? It's not just a volume pattern, but again, it's about understanding the psychology of the participants. It's saying they were in a hurry to get out. Maybe they were motivated by something. Maybe they were motivated because it broke support. Maybe there was news. We don't know what their motivation is. We can guess and we can assign our ideas to why something might have happened. But we don't know. But we do know that support broken tends to act as resistance. The moving averages tend to act as resistance. So here we have a 10 and 20-day moving average. The lighter volume tells us that people were in a big hurry to get out of it. But now that it's bounced, there's really no vigor here. There's no real, Warren Buffett's not in there saying, I want as much as I can. Instead, it's a low volume bounce, and low volume bounces tend to fail. So when we'll look at an intraday chart and then the daily and intraday chart together in a moment. But what we want to do as we see the stock has rallied up to this prior level of support, which tends to act as resistance. We want to start coming up with our plan. And we say, as I always like to say, ask yourself 2 questions. Where has it come from? Where does it have the potential to go? So if we look at the stock, we'll go back to the daily chart for just a moment here. Did I click the back arrow? So, again, shorting after a few days of decline, you want to ask yourself, do you want to short at 48.5 when the bad news came out after it was just 52.5 3 days earlier? Generally not, because it's expended the energy on the way down. The news might be out. And then you want to look, further to the left and say, where does it have the potential to go before it's likely, in the short case, to find support? So we ask these questions to say, now, based on the answers to those questions, does my perceived risk here, is it enough for the potential profit that I have? And in technical analysis, when you're eyeballing it and you're looking at the charts, you can squint your eyes, turn it upside down, and try to convince yourself of anything you want. People will convince themselves, well, I think it's turning around on that last, daily chart there. But if you have the statistical edge, you've back tested it the way Holly allows you to do, the trade ideas with all the different tools and techniques to say, how does this work in the past? Well, then you can look at it and say, now I have a good risk reward. I have the opportunity to get involved in this stock. So this is the same exact stock. And what we see here is this area right here. That's the bounce that occurred on the light volume. I don't have the volume on this shorter term time frame. I like to keep my charts very clean. So I've got a 5-day moving average, but it bounced, it pulled back, and it made a lower high. So when it comes to setting stops, as I say here, we want to short when the stock breaks back down below the flat to declining 5-day moving average. When it makes a lower low below that, that's where our entry is. And then where do you set your stop? Well, do you use 5%? Do you use 7% or some random percentage number? Or instead, do you use the definition of trend? The definition of trend, a downtrend, is lower highs and lower lows. So if I short right here as it's breaking down, I have 2 lower highs that I can look at. Now, maybe I'll put half of my stop here just because I don't want to get shaken out if it's just a little quick rally, and then the other half up here. Or maybe I'll put the entire stop above this level, and as it breaks down further, then I'll lower my stop to the prior most recent relevant lower high, relevant to your time frame. If you're a day trader, well, then you want to look at where, maybe if it gets back above VWAP that day, then I'm going to cover my short. It's all time frame dependent, but we want to look at it and use multiple time frames together so that after you've looked at charts for decades, as I have, you know what the intraday looks like. So this, you can just picture it in your head. They say, candles are only, relevant at the end of the day when they close. My honest opinion of candlestick charts is they look good, but I've never, ever made money trying to identify 3 counting crows or the baby in the bathwater. That's a fake one. But it sounds bearish. But the point is they look good. And if you see, when you get involved, this is the same exact spot. When the momentum comes back down, you don't want to short on the way up because maybe it is that rare time where it just keeps going higher. Instead, we wait for price confirmation. So we're anticipating in here, and we actually participate there and set our stop, and then we manage risk. That's our job. The risk of selling short, though, or if you just look at this chart, what I've got highlighted here in the green, these are rallies in a downtrend, and look how sharp and ferocious those are. If you're short this stock, even from this point right here, let's say, it drops precipitously and you're feeling like a hero, then 2 days later, 90% of your profit is gone. What was maybe a 15% move is gone. You've got to be much quicker, I think, in shorting, in covering your shorts, that is. You've got to be a lot more careful. You have to be paying attention. Only, again, it's the definition of, it's the math of the downtrend. The fear of being short, though, why do they get those violent rallies? Because theoretically, the loss potential for a short seller is unlimited. You can short it at 10, it can go to 20, 30, 40, 50, 70. We'll talk about a stock that did that was already mentioned earlier. That's but anyways, the potential for loss is unlimited. Don't short after a couple days decline, especially if there's bad news. And be quicker, I say, to take partial profits. You know, one of my big things that I do each day when I get into a swing trade, and if I've got a $30 stock, I'll look at the pivot levels, daily R2, daily S2. And I'll tend to cover a third of a short as it hits daily S2, or exit a third of my long at daily R2, because they often act as resistance, because there's program traders based around that. We're trying to anticipate what the rest of the market is doing. What does the rest of the market consider valuable? How can I anticipate when they're going to get involved, and then manage the risk? That's the most important part of any strategy on any time frame. My favorite Alan Greenspan quote, it's the only one I know, but it's kind of geeky to have a favorite Alan Greenspan quote. My job is that of risk manager for the economy. Now, I'm not saying we're qualified to run economies, but we're qualified to manage risk. Our job is no different than what he viewed his job as the Federal Reserve Chairman. Risk management is job number one. So when we have a stock and we're short it, and it starts to decline, and we get involved right here as it's breaking down. So this is a daily chart on the left, and this is an intraday time frame. Looks like probably 30-minute candles. You know, if we short that right there and we set our stop above one of these lower highs, as it makes a lower low, we lower our stop. We lower our stop to the most recent relevant lower high. Behind those is where we want to be stopped out, and listen to the message of the market. People will say, hey, Brian, you like this stock short at 30, breaking below 36. What's the price target? I don't know. It's up to the market. But it looks like on the daily chart that we should probably see at least a test of 35. That seems reasonable. But if it's truly going to continue in a downtrend, then it's going to make a lower low. So I guess the target's somewhere under 35. My opinion of what the target is there at the beginning just to assess, is the potential reward worth the risk? But I don't want to limit my profit to $35 a share, because there was no reason at 35 to continue to cover your short, because it continues lower highs and lower lows. So listen to the message of the market. So the exciting part, and this has really been where there's been some great opportunities in the market. Steve Gomez has an algo that looks for short squeeze candidates, a strategy that is, on trade ideas. And it's a great place to start to look for some of these. A short squeeze real simply is when there's short sellers in the stock and they're trapped, basically. How do you lose money in a short sale? Well, the stock goes up. So if the stock goes, you're short at 30 and it goes to 32, okay, I'm down $2. 33, you're out 10%. Where do you cut your losses? The fear, again, is unlimited upside, and that can be a real driving factor. But short squeezes aren't as simple as they seem, because these shorts can be very stubborn and they're very active, much more active than I think a lot of people realize. But the fear of the short seller is that potential of unlimited losses. So what drives a real, true, strong short squeeze is the fact that a lot of times you've got a stock breaking out to new highs, meaning that everyone who's long the stock is making money. They are in a position where they're feeling, I don't need to sell to break even. There's not a lot of supply, the natural supply from people trying to get out break even. And then you've got buyers. You've got breakout buyers piling in, going, hey, this is a great story. It's making new highs. It's a great story. I like this stock. I like the company. And then you've got the short squeezes, the short sellers, who are looking at it going, wait a minute, the bus left the station. I'm going the wrong way. And that adds another source of demand. It's like throwing fuel onto the fire. So they can be extremely dynamic on the upside. So let's talk about where to find the information, for one thing. There's all kinds of sources you can find it. Here's just a couple: NASDAQ.com, FinViz, ShortSqueeze.com. The problem with the short interest that we get reported, and it's crazy that it's this stale, but if you look at the most recent data was reported on the 26th. So that's when, at 4 p.m., that's when the NASDAQ says, here's the short interest on a stock. What happened, though, is that's the information from the 15th of September, 10 days before. Okay, that's the settlement date of the trade, T+2. So that means it was actually as of September 13th, that's when the short position is reported. So it's that stale. So you have to look at it with a little bit of understanding of, well, wait a minute, maybe that's not what it is all the time. That we should be able to have the information available on demand, really. And I'm going to show you a site in a moment that's starting to go in that right direction. So the terminology, short interest ratio, also known as days to cover, what that simply means is if you take the total number of shares short at the end of that reporting period, September 26, let's say, and it says there's 2 million shares that have been shorted, that aren't covered, that are still out there in the public. So if the average daily volume of the stock is 2 million shares a day, what that means is theoretically, if the shorts were to cover, it would take them 1 day of average daily volume to cover that. If instead the stock trades an average of 500,000 shares, it would be 4 days to cover. So their covering is more difficult, in other words. And if it's just 250,000 shares, then you've got 8 days to cover. I consider anything over really 5 days to cover to be pretty significant. But what we want to understand is where they're short from and what's, are they trapped? Because that's when they can really add that dynamic fuel to the fire, and you can see the huge upside. One real quick thing to point out here is that on this stock, you can see we've got 3 reporting periods. That's every 2 weeks. The short volume, the number of shares short, really was unchanged. But what you see is the days to cover went from 1 1/4 to maybe half that. So what does that mean? Well, there's a numerator and a denominator. Okay, the numerator is the number of shares. The volume, average daily volume, is the denominator. So as the stock becomes more liquid, on average, they have less effect getting in. So don't rely just on days to cover. There's also scans for percentage of float short. I think generally above 15% is what I like to see. 15, 20, you're starting to get pretty interesting and see the potential for that squeeze to happen. But again, how accurate is this data actually? And if you look at VERI, I'm sure most people here are familiar with this stock. It was an IPO earlier this year, kind of did a whole bunch of nothing. Then they said they were an artificial intelligence company. And it just went bonkers. I mean, it went from 10, 20, 30, 40. And there were people along the way saying, hey, it's up too much. I'm going to short it because it's up too much. And if you look at it, though, the data on here says, well, there's only 480,000 shares short. What really happened, though, is on the 19th, when the stock really, right here, and I'll go to the next slide for this to view it a little bit more carefully. Write this site down, shortvolume.com. What they allow you to do is they get their data from FINRA, and each day they say, here's the volume in the stock. Here's how much was transacted on the short side. Here's the ratio of short to long, and here's how many shares. So you see, kind of a whole bunch of nothing. But on the 19th, the short sellers started to get pretty interested in VERI. And they got interested on the 20th, the 21st, and all the way through here. Finally, the day that Citron reported their hit piece on the company, the shorts really piled on, and that's when the stock started to get hit. But the point is, if you just look at traditional short sale value, you're thinking, well, 400,000 shares, no big deal. They probably got washed out of it. But what we saw happen instead is that they were trading, better than, what is that, about 500,000 shares a day 7 days in a row before it actually broke. So there were a lot of people, I like to call it a short squeeze machine, a perpetual short squeeze machine when this happens. It's not perpetual, but what happens is, let's say I'll short it at 20, I realize I'm wrong, I buy it back at 22, but somebody else says, hey, it's up too much, I'm gonna short it at 22. So you keep churning through these people on the upside, and what happens is, again, as John Maynard Keynes says, the market can remain irrational longer than you can remain solvent. Is Bitcoin in a bubble? Is it similar to tulips? Who knows? But don't fight it. Don't try to short it. You're going to get run over. So the characteristics of a short squeeze are we want to see a stock in an uptrend. It's either in an uptrend and it's close to a 52-week high like Steve's scan, or it's maybe in a stage 1 accumulation ready to break out. And we'll see that they're often a fad stock. I don't know if you guys have seen National Beverage. FIZZ is the symbol on this one. It's a soft drink company, and it's gone from 20 to 120 in the last 6 months. And I keep looking at it, and I know there's people, and I look at that short interest daily data, and people are trying to short it every single day, but it just keeps going up. It's a fad. Eventually, the fundamental guys are going to be right on that stock. I'm convinced of that. There's no reason for a soft drink company to go up 500% when everyone hates on soda and they're taxing it and all the fundamental reasons that make sense. Don't confuse the story with the price action. If it's in an uptrend, respect the fact that the buyers have control, because you can lose everything being stubborn. So we want to know the approximate level that a short, that they're engaged in the stock. That way we can know their pain level. A stock at a new high, obviously, all the shorts are going to be losing money. Similar to a stock on the way down. For years, people have been trying to pick the bottom in Twitter. And each time it makes a new low, it tells you that every single person who bought it and still holds that stock is a loser. Not the traders, but the people who hold it. So we want to know, again, the two types of short squeezes. What I call the knee-jerk short squeeze. It's a stock that's generally in a stage 4 decline. That's a dead giveaway. So it's already guilty till proven innocent. But some of the fastest, strongest rallies occur in a downtrend. That's just a fact of the way stocks trade. It's got declining moving averages. The sellers are in control of this stock. And you'll see rumors of takeovers, like BlackBerry or Sears Holding, or you'll see the fundamental analysts come on television about how great Foot Locker is, and then they report earnings. And by the way, that Foot Locker failed right at the year-to-date volume-weighted average price if you look at it. Anyway, so there's this violent emotion because people are scared to death that they're going to lose. But if the trend is still lower, for sure, you can trade those things for a couple days. They make great long candidates if you're managing risk and if you're involved in them. If you're in for a couple days or a couple hours, great. You're piling onto the momentum if that's your way of looking at it, then that's fine. Bed Bath & Beyond, which is coincidence, it's another retail stock that was spoken about earlier. But here, the stock, the best case that this stock was going to turn around occurred over in here. But even at that point, we had a declining 200-day moving average. So it told me, okay, if it can make a higher high above that level, then perhaps we're ready to get going. It broke out, but then it failed. And over here, it started to turn higher. That's this level right here, right before earnings, because Dana Telsey probably told her customers, or hey, we like the foot traffic. But the fact is, it got a bounce for a couple days. They reported earnings. And again, with all the declining moving averages, forget the story. Just look at it and say, if this was a takeover company, let's say, a rumor, look at it. Does it look like there's big, that someone, did someone file 5% or 10%? Do they have a name of who might be buying this? Is there actually any evidence through filings or on the chart? Has it gotten above the 10-week moving average? It can't even get above that, which is the 50-day moving average. So we saw it and this did fail, and this is another knee-jerk short squeeze. It's got a declining 50-day moving average. When a rally has a 50-day moving average that's declining, it is generally going to fail. Take a look at charts of any stock. Look at the direction of the 50-day moving average. The semiconductors have been a great example. People have been trying to short the semiconductors all year. And it's broken below the 50-day moving average a couple times this year. And each time it does, people say, hey, it's below the 50-day moving average. It's over. And I say, what's the direction of the 50-day moving average? It's not one or two closes below, and it's not one or two closes above a 50-day moving average that makes it bullish. Best case scenario for a stock like Shake Shack, stage 2, 3, stage 4, if they don't scare you out down here, they're generally going to wear you out. And it's in a range. There's no reason to think that these short sellers will panic. They're adding to their short position. Maybe that's wise, maybe it's not. I don't know, but it's been down in this 30 to 37 range for close to 2 years now. It's a dead stock unless you're trading ranges and shorter term time frames. And there's nothing wrong with trading the time frame that makes most sense to you personally. For me, I look at it and say, maybe I've got a good little trade in here, but I certainly want to be suspicious. I live in Colorado, and I'm kind of addicted to charts, so I look at the weather and and the snowpack, and every year, it goes up, and every year at the end of the season, you can count on it. And you notice a big storm will come through, and the chart blips up, but it's not going to affect the overall trend. Summer's coming, snow's melting, the snowpack declines. And that's the way you have to think about it in a stock as well, that it's more likely, it's not guaranteed like the snowpack, but it's more likely that it will get snowpacked, as I like to say. It'll get packed back down because it's a piece of garbage stock, and it should stay down until you have evidence that the buyers are actually gaining control. And that's where we talk about a structural short squeeze. So understanding market structure, again, the poster in front of you and the 4 stages. When a stock is coming out of a longer term stage 1, so maybe Shake Shack in the next year runs up to 37 where it's had resistance, pulls back, makes a higher low at 35, and then hangs on up in there and comes up to 37 again, reduces supply, pulls back to 36, makes a higher low, and then it breaks out into a stage 2 uptrend. But the point is, the buyers are in control. It's not a neutral stock. It's coming out of that neutral time frame, and the buyers are regaining control. And that's where the shorts start to say, what do I want to do with this thing? Do I want to fight this and try to put a cap on it? And you'll see that a lot of times with a heavily shorted stock, that they'll fight it for a little while to discourage the breakout buyers. But if it's truly going to break out and the shorts are in trouble, well then, here's a stock that's now in an uptrend. Take a look at a stock like Boeing, boring old Boeing, a Dow Jones industrial company. And here you can see on a weekly chart that goes back a couple of years, it did a whole bunch of nothing, but then it started to make these higher lows, and it more repeated tests of that resistance. When it broke that resistance there, look how many shorts there were. There were about 23 million. They started to cover in here a little bit, but still, this is a structural short squeeze. At this point right here, not one of those short sellers was making money. Now, we don't know if they're hedged, if they have convertibles, if they have call options. We have to build some assumptions in. But when a stock is breaking out and the trend is higher, it's nice to have this potential source of demand. What they do with it is anyone's guess. Maybe they're buying calls, maybe they're short Martin Marietta against it, or whatever complex strategy they have. We have to read into it and understand. Only price pays. We have to look at the price action and say, we have all this information, but at the end of the day, what's the most important thing we see here? We see price action rising. And now I want to look for a low risk, high probability area to get involved in this trade and manage risk and assume that a trend once established is more likely to continue than it is to reverse. Lam Research is a semiconductor equipment manufacturer. And it had a great run in 14 into 15. Then it turned, it looked like it was breaking down, a false breakdown. So, nothing wrong with being short right there, but cover as it goes back up. Then it corrects through time, and it's giving us some hints that the buyers are getting more aggressive with these higher lows and more repeated tests of resistance. And as it breaks out to a new high right there, look at how many shorts there are, 30+ million shares. The short interest ratio at that point was about 12. Now the shorts are coming out of that, and the short interest ratio is declining. But look at the rallies that you see here. It's throwing that gasoline on the fire and helping reinforce the trend that they're trying to fight. They're trying to get out as quickly as they can, and here they couldn't do it quick enough, obviously. Now you'll probably start to see the short position build up again in here, and then maybe it goes sideways and corrects through time, or maybe they get it right this time. We don't know. But if you look at, this FireEye came public a couple years ago, and what came out, it was a hot IPO. It had a nice run, and it distributed, and it got below all these moving averages. And people said, well, hey, it's a good company. It's FireEye, and internet security. We look at Home Depot gets hacked. This company gets hacked. We need this security. And that, Target and Home Depot all got hacked in here, and you get a little bit of a bounce. But what we saw was if they didn't scare you out, they wore you out. Now, over the last year, the energy's been building in this stock. This prior resistance has been broken. Moving averages, what's the direction of the 10, 20, 30, 40-week moving average? They're all turning higher. It tells us that the sellers have been moved out of this stock. They've been moved aside. Now the buyers are gaining control. FireEye has 26.8 million shares short. Where are they short from? Mainly underneath this level here. We look at how many shorts, have been added from that point on, from this decline. Well, now if you put a volume-weighted average price from that point, you'd see that it's at about $15 a share, telling us that the average short position is now in a losing position. We've got a stage 2 uptrend. We've got a big catalyst here. Equifax got hacked. Who did they hire? They hired FireEye. I'm not a fundamental guy, but I read headlines and I say, does it make sense? Well, let me look at the chart. I don't need to know every little nitty-gritty detail about it, but I see a great chart with a potential source of extra demand here. This gets my attention. This is the type of stock that potentially could be heading back up to 30, 35. If I was an investor, I'm not an investor. If I was an investor, I would look at this and say, I want to put my stop maybe under that $15 level. I'll give it $2 risk, and underneath the 10 and 20-day moving average, 10 and 20 week, or 50 and 100 day. And here's something that I will continue to raise my stop underneath the most recent relevant higher low for my time frame. So for an investor, maybe it runs to 20, it pulls back to 18, goes to 21, then I'd put my stop under 18. For a shorter term time frame, I want to look at the daily chart. And right now, I think that at Alpha Trends, the site that I have, where I give recommendations each day, we had this one on our watch list starting on Wednesday to buy it above $17.20 per share. It hasn't done that yet. $17.20 is at this time, and things might change, it might just completely, it might fall out of bed here. No harm, no foul. I'm not in it. I'm waiting for it to make a higher high on my time frame and then to manage risk. And I look at it and say, does the bigger picture support there could be a powerful move? It's fresh in an uptrend. This is the type of stock that institutions are going to continue to support. This is the type of stock that there are hedge funds out there who target short sellers. They say, let's just go buy and buy and buy on the offer and get these guys to cover. Let's create the fear. As they say, stocks don't move, they're moved. There's someone behind it saying, let's put the pressure on these shorts. So keep an eye on FireEye this week. Keep an eye on CARS, CARS. This is a recent IPO. This stock came public in June. And it kind of lackluster back and forth. I didn't want to make my charts are usually very clean. I use volume-weighted average price levels. And here from the IPO, this is the volume-weighted average price from the IPO. I started watching it for the most recent opportunity to buy somewhere in here, waiting for it to kind of show us that the buyers are in control. And it continued down. It didn't find support at that volume-weighted average price year to date. I thought it would hold there, but I didn't buy it. I said that's a point where it should find support, so I want to look at a shorter-term time frame for momentum. It never developed that momentum. It had a shakeout below it. Now it's back up above that volume-weighted average price. You take out last week's high, or the high of Wednesday, I think this stock gets going. There's 25 million shares short. Who looks at patterns when they trade? What pattern do you see on this? Is there a bullish pattern? V bottom, or even shoulder, head, shoulder. Here's a big neckline up there, inverted head and shoulders pattern. But the point is, this will be a very important higher low for a longer term player. If the stock breaks back below there, then I think the shorts probably crush it. But right now, I'd be pretty nervous if I was short this stock. The average price the stock is traded at is 20, just under 26. They're not in trouble yet, but they certainly have the potential to get hurt pretty badly in this stock. And a lot of times the IPOs end up being the really good, they attract the short and get that big short squeeze going in a stock like this. So the risks in short squeeze candidates, well, short sellers aren't stupid. They do a lot of work. They do a lot of work looking into the company, and particularly in biotech stocks. I mean, you see these biotechs imploding. There was one last week. I think it was VERS, actually. It was looking good on one day. They had fundamental data. It went from 23 down to 3 overnight. Everyone talks about the ones that go from 2 to 8, but in biotech land, be aware, they're a different beast. They're a completely different beast. So, we don't know where they short. We don't know why they're short. Maybe they have some fundamental information. We don't know how fresh that data is. That shortvolume.com, though, really can help you identify where the true shorts are for the near term. If you're going to trade on the short side, or even on the a squeeze candidate, maybe you reduce your risk, or you try to control your risk with option strategies. There's a lot of ways to make money in the market. Risk management is always number one, and you've got to understand who you are. You have to understand the personality of the stock that you're trading and the nature of the market itself. We're not in a good environment right now to sell short and expect to make money. That's going to change one day, so you better know how to sell short and understand the dynamics of how these short-term short squeezes work as well. Where is there? That's the end. Thank you for attending. Thanks for trade ideas as well. You can follow me on Twitter @AlphaTrends, and my book, Technical Analysis Using Multiple Timeframes, is on Amazon. Questions? Yeah.
So you were quite clear on setting a loss stop and that. You said you don't have a particular point where you take the profit or you have a profit target. Can you tell us exactly or specifically what's your kind of process of getting out of the trade when it goes in your direction? And another question, for some of us, we are not able to plot VWAP from the particular term, but rather we use daily VWAP. That's by the, so if you want to expand a little bit of usage of that, and do you see any value in that?
Let me handle VWAP first. That's my pet indicator. I've been using it since 2004. And I think it's the most valuable indicator you can use. And if you have a charting platform that doesn't have it, send them an email, get other users to send them an email, or find a charting platform that has it. It's to me, it's like trading blind without it. Your earlier question about a price target. So if I see a stock in a downtrend, and this is what I do every day on Alpha Trends, I identify swing trade candidates for subscribers to Alpha Trends, and I say we're going to look to short this stock below 25, and our stop will be above that most recent relevant lower high at 25.65. If on that very first day it drops to daily S2, which might be at 24.65, I'm going to cover a third of it. Not because I want to make 35 cents, but because that often acts as support, at least intraday. It allows me to take some risk off. Now, if I can lower my stop on the balance, that's great. And if the stock drops the next day, I'll lower my stop again until maybe I feel like, well, it's getting a little bit out of hand. I'm going to take some off. So there's a discretionary aspect as well. But generally, a stop will trail down below the most recent relevant lower high for the time frame I'm engaged in. So let me let some other people get some other questions here. So yes.
So one quick question on the charts that you showed with the short interest and the days to cover on strictly the every 2-week reporting?
That was the 2-week reporting, right, yes.
Then on the shortvolume.com, how do they get their data? Are they estimating it? Or
No, they get it from FINRA, and I actually sent them an email, which they haven't responded to yet, to get some more information about it. So when I find that out, I told them I'll tweet about it and bring them some traffic, hopefully, to kind of motivate them, because I wanted that answer for today. I don't have that for you. Yeah.
When it says that they're a company's large institutional owned, why would the shorts, how would you pick a way to short that? If it seems like if it has a large institutional own, they would be buying up.
Well,
If it covers on the amount of float or something?
Well, a large institutional owned stock is actually often a good candidate for a short if it's in a downtrend, because now you've got this mass fear that they're going to get out. It's over-owned, as they say. If it's 80% institutionally owned and it's starting to decline, the reason the 200-day moving average is declining is because the big money is getting out of it. Maybe slowly to start, but as it starts to break down and roll over and hit stops and create committees to come together and say, hey, why are we so heavy in the stock? Let's sell 20% of our holding in that. So it reinforces the downtrend. It's better to have that big institutional base. Yeah.
You talked about VWAP quite a bit lately, and then, or for as long as I've been following it, but then lately you've been talking about anchored VWAP. Can you explain the differences?
Anchored VWAP, I'm proud to say that on a competing, it's a charting platform really, so TC2000, they were, I've got a good relationship with them, and I said, hey, is there a way to get a VWAP from a specific point? Because I used to, measure it as a straight line across, and it would calculate it. But the anchored VWAP, so they were kind enough to say, we will call it the anchored VWAP by Alpha Trends. So it's available there. There are other places that Optima this past week said they're putting it on their charting platform. But basically, and I've got a lot more information coming on VWAP. That's not what we're here to talk about today specifically, but it allows you to get the psychology of the participants from a certain point. So if you take Veri and you say, okay, on the 19th, they started to add their short position. Well, if I take a look at the volume weighted average price from that day, I know that the average participant on that day was down X amount. And it rallies up the next day and they add another 500,000 shares. I say, now we've got two piles of guys and their new average between the 2 days, and so they're feeling pain. But if it breaks below that volume weighted average price, now they're feeling like maybe we can press this stock really hard. We're gaining back control. So it's understanding the psychology of the participants from a certain point, from the date of an IPO, from the date of earnings, from the date that it began a pullback, okay? So, other questions? Dan?
You had touched upon this in the panel, but I wanted to, because I think it relates to what you were saying. When we were younger, we would day trade because that was something that we did. But it seems like now, as I've gotten older, and I think you confirmed this, would you agree that day trading becomes a function of risk management versus a style?
For me it is, and I think for you, it's I don't really, if I see what looks like a layup day trade, I'll take it. But I don't sit down at my desk the way these younger guys do and say, hey, I'm here to day trade and duke it out and fight every day. So yeah, it's a function of risk management that if it's not right, if it's not working, I get stopped out, I take my small loss and move on. But I want to hold my winners. I want to be a swing trader. I don't, how long do we hold it? Well, till it tells us to stop holding it. What's the price target? Higher, for my longs.
I think this is the most critical part that people don't actually understand about active investing is that the notion is not to get out, but to stay in. But getting out is that function of risk management, and most people think like I just need to get out. And it's a slight misconception.
Agreed. And the market recently has been really rewarding and telling us to hold stocks. Whereas 6 months ago, a choppier environment, you'd get in a stock, it'd rally a little bit, you'd sell some, then it'd kind of drift lower and you get stopped out, and dud after dud. Now we're getting these rocket ships. So it's easier to hold because the market's telling us that. We're not saying, hey, I need to sell after the 8th day. That's foolish. It's not, I want to cover my short if I'm down 3%. I want to cover my stop short when it makes a higher high on my time frame, because now I'm short because lower highs and lower lows. If that doesn't exist anymore, why would I be short? It's stupid. Other questions? I think we are out of time, and we've got a great...
Give it up for Brian Shannon.
Okay.
Thank you,
No more
Brian.
questions. Thank you.